This is Group 2, reporting on All Homes' asset liability management and financial report to see if they are prepared for inflationary pressures in future. And without further ado, let's start.
For the company profile, All Home Corporation or HOME, founded on May 29, 2013, is a leading stock corporation specializing in home improvement and construction. The company offers a diverse range of products in 8 categories, including furniture, hardware, appliances, tiles, sanitary wares, homewares, linens, and construction materials, featuring over 800 brands both local and international. Their services include interior design consulting, customized furniture installation, delivery, and free assembly. All Home, an affiliate of Vistaland, opened its first store in Pampanga in 2013 and has gradually become a trusted name in home building needs among Filipino households. With the tagline One Stop Shop for Your Home, it aims to help customers build their dream houses and provide comprehensive solutions and exceptional customer satisfaction. As of December 31, 2022, All Home operates 60 stores nationwide, with 45 in Mega Manila and the rest in Luzon, Visayas, and Mindanao. In the coming years, the firm plans to continue expanding its reach to offer customers more diverse options and possibilities for their home goals.
So All Home Corporation is run by a board of directors. The members of the board include Manuel B. Villar Jr. as the chairman, Camille A. Villar as the vice chairman, Benji-Marie N. Soriano as the director, president, and chief executive officer, Francis T. Coloma as the director, treasurer, and chief operating officer, Manuel A. Villar as director, Jesse D. Cabaluna as independent director, and Raul N. Esteban as independent director. In addition to the board of directors, All Home Corporation also has senior management that consists of key executive and corporate officers. The members of the senior management include Francis T. Coloma as director, treasurer, and chief operating officer, Benji-Marie N. Soriano as director, president, and chief executive officer, Robbie Rose M. Abbott as chief financial officer, risk officer, and investor relations head, Luella M. Fernandez as controller and compliance officer, Arvin P. Carino as corporate secretary, and Vanessa L. Buazon Crisol as chief audit executive.
All Home stock peaked at 11 pesos and 50 cents per share during its IPO in September 2019. Despite opening 2 new stores during the pandemic, the company's net income grew by 46% in 2021, but declined by 35% in 2022, with continued poor performance leading to a drop in stock price and volume as shareholders shifted investments.
All Homes' net income dropped by 35% in 2022 due to reduced foot traffic and shifting consumer spendings post-pandemic. However, it showed resilience by surpassing pre-pandemic earnings in the first half of 2022 with a net profit of 525 million, a 21% increase from 2019. All Home opens its 56 and 57 stores in Mandaluyong and Las Piñas, aligning with its strategy to broaden its reach in Metro Manila. All Home also focused on enhancing its home construction category, aiming to generate half of its revenues from post-pandemic construction activities. Now, despite a recent 52.7% drop in stock price, All Home posted a net income of 582 million in the first 9 months of 2023, a 46% increase from the previous year, driven by revenues of 8.78 billion pesos. The company excelled at the 2023 Higher Business Partners Convention, showcasing its commitment to product innovation and high-end transformation strategies. All Home received an Arrow Award for Good Corporate Governance at the 2023 ACGS Golden Arrow Awards, underscoring its dedication to strict corporate governance standards.
So based on the annual reports of All Home Corporation for the year 2023, it can be observed that the net interest income of the company has increased from 1.4 million pesos in 2022 to 1.5 million pesos in 2023. Now this entails that for the year 2023, the investments made by the company managed to be profitable even with the increase of interest income. Now, for the non-interest income, it can be observed that the value slightly decreased from 254 million pesos in 2022 to 222 million pesos in 2023. This infers that the company's other forms of making profit did not perform as well compared to the previous year. It can also be observed that there was a decrease in total expenses from 11.3 trillion pesos in 2022 to 11 trillion pesos in 2024. This infers that the company managed to find ways to cut spending, which plays an important role in keeping the company stable considering the sales were down from the previous year.
All Home managed its assets strategically in 2022 and 2023, seeing as total assets grew slightly by 230 million pesos. Cash and cash equivalents decreased by 6% due to cash being used for inventory purchases, new store capital expenditures, and maintenance of existing stores. Receivables rose by 5% due to delays in collecting corporate sales at year-end. Inventories increased by 10% due to lower sales and leftover inventory from holiday buys. Property and equipment decreased by 6% due to spendings on new stores, upgrades, and software improvements. The inventory turnover ratio, which measures how often inventory is sold and replaced, dropped by 0.08 with a 24-day increase in collection period, suggesting slower inventory sales or potential overstocking or inefficiencies. The accounts receivable turnover ratio indicates how effectively receivables are being collected, and it fell by 8.77 with a negative 3-day difference in collection period. Due to customers delaying payments, thus affecting cash flow, All Home may need to tighten credit policies or improve collection processes. The total asset turnover ratio, which shows how effectively assets generate sales, slightly decreased by 0.03, which is reflected in its 49-day increase in collection period. This signifies a slight decline in sales efficiency likely due to reduced sales and profitability. Revenues fell from 12.56 billion pesos in 2022 to 12.07 billion in 2023, and net profit dropped from 934 million to 797 million, impacting the ratio. In summary, comparing 2023 to 2022 ratios, All Homes assets management ratios aren't doing as well as they did in 2022.
For All Homes liability management, as of December 31, 2023, its total liabilities decreased by 3.5% compared to 2022. The following key factors contributed to this. Loans payable increased by 2% from 5.94 billion pesos to 6.03 billion pesos due to new borrowings for store expansions. Lease liabilities reduced by 12% from 3.75 billion pesos to 3.31 billion pesos due to lease payments made. Income tax payable soared by 734% from 4.8 million pesos to 39.4 million pesos due to a switch from the minimum corporate income tax rate to the regular rate in the fourth quarter. This also increased the deferred tax liabilities by 34% due to adjustments made for temporary tax differences. Then retirement benefit obligations rose by 95% in 2023 due to changes made in the provisions. Overall, All Home effectively managed its liabilities by reducing some obligations and increasing borrowings to support investment and growth. However, the significant rise in certain liabilities should be monitored for balanced financial health. In 2023, All Homes debt ratio decreased slightly to 0.41 from 0.43 in 2022. This implies that the assets financed by debt have decreased. Thus, the firm's financial risk has reduced due to less reliance on debt financing. Additionally, the debt-to-equity ratio improved from 0.75 in 2022 to 0.69 in 2023, reflecting reduced financial leverage and risk, as the firm's liabilities are relatively lower compared to its shareholders' equity. In short, the decrease in both ratios suggests its reduced reliance on debts, more conservative financing, improved financial health, and lower financial risk.
Interest rate risk. Debt structure shift. All Home has transitioned from short-term to long-term debt. This strategy reduces exposure to fluctuating interest rates. Impact on financial performance. Short-term debt fluctuations increased from 1.06% in 2022 to 1.42% in 2023. This heightened sensitivity to interest rate changes could impact profit by more or less 23.5 million in 2023 and 18.8 million in 2022. Long-term debt diversification. Long-term interest rates expanded from 5% to 7.09% in 2022 to 2 to 8.5% in 2023. This provides more investment options with lower interest rates. And lastly, debt servicing capacity. Interest coverage ratio decreased from 3.02 to 2.33. While capacity to serve debt has weakened, All Home can still meet its obligations.
Liquidity rate risk. Liquidity ratios assess a firm's ability to convert assets to cash or acquire cash to meet short-term obligations. This analysis will help determine if All Home Corporation can handle inflationary pressures. There are three main liquidity ratios. There is the current ratio, which measures the company's capacity to fulfill current liabilities using current assets. The quick ratio, which also shows the firm's ability to meet current liabilities with short-term assets. However, it's also excluding inventory. And lastly is the cash ratio, which tests the ability to meet daily operational requirements, and this is calculated by dividing cash and cash equivalents divided by current liabilities. As of 2023, All Home's current assets were 30.1 billion and current liabilities were 4.93 billion. Their inventory was 7.28 billion and its cash and cash equivalents were 1.66 billion. Let's compare it with its 2022 values, and we can see that its current assets increased by 1.16 billion pesos, current liabilities decreased by 486 million pesos, inventories increased by 649.35 million pesos, and cash and cash equivalents decreased by 110.2 million pesos. These changes indicate improved liquidity, suggesting stronger short-term financial health. However, the decrease in cash and cash equivalents by 110 million pesos highlights the need for careful cash management to maintain operational stability. Let's now analyze the ratios. The current ratios increased from 2.21 to 2.67. This indicates improved liquidity and a stronger ability to meet short-term liabilities. The quick ratios also increased from 1.0 to 1.193, showing enhanced capability to quickly pay short-term obligations, which is crucial in times of crisis. Lastly, we have the cash ratio, which slightly rose from 0.33 to 0.34, reflecting a minor improvement in meeting near-term obligations with cash and cash equivalents. Although the cash ratio remains below 1, which means that it doesn't have enough cash to cover current liabilities, there is an upward, albeit little trend, which suggests better liquidity. In conclusion, All Home Corporation's financial health has improved since all three ratios increased. This means they can pay for short-term obligations, which suggests the company is well prepared to counter potential inflationary pressures.
Based on the previously discussed ratios, the researchers determined that the company is effectively managing credit risk and maintaining a solid loan repayment schedule, with measures to monitor and mitigate potential defaults.
This decision matrix shows a final score of 3.20, which means it is mostly unprepared for inflation.
Overall, the researchers utilized the decision table and determined that All Home is currently underprepared for future challenges. These concerns highlight the issues in stock performance, net income growth, asset management, along with others in which the company should address to improve financial stability and operational performance.
We recommend that All Home should enhance operational efficiency by optimizing inventory management and streamlining receivables to address its lower turnover and payment delays. By investing in marketing, customer engagement, and e-com capabilities, they can boost sales and broaden customer access. Increasing long-term financing while minimizing short-term loans will improve financial stability and sustain investor trust through better corporate governance.
And that's all from us. We are Group 2, signing out.